The New York Stock Exchange is one of the world's largest and most prestigious stock exchanges, serving as a marketplace for the buying and selling of shares in publicly traded companies. Established in 1792, the New York Stock Exchange has a rich history of fostering economic growth and innovation through the efficient allocation of capital. The exchange is located in the heart of New York City's financial district, within the iconic Wall Street, and is owned and operated by the Intercontinental Exchange, or ICE, which is a leading operator of global exchanges and clearinghouses. The New York Stock Exchange provides a transparent, consistent, and efficient marketplace for trading equities, helping to determine the market price of stocks and acting as a platform for companies to raise capital by issuing shares. It plays a crucial role in the global financial system, facilitating the flow of funds between investors and companies and promoting economic growth and job creation. The primary function of the New York Stock Exchange is to facilitate the trading of stocks between buyers and sellers. This is achieved through a system known as the continuous auction market, where buyers and sellers interact with one another to determine the market price of a particular stock. The continuous auction market is supported by a network of market participants, including brokers, dealers, and market makers, who work together to ensure that orders are executed efficiently and at the best possible price. Market participants. There are several key participants in the New York Stock Exchange trading process, each with distinct roles and responsibilities. Number 1. Listed companies. These are the publicly traded corporations that have chosen to list their shares on the New York Stock Exchange. By listing on the exchange, companies gain access to a large pool of potential investors and can raise capital through the issuance of new shares. Listing on the New York Stock Exchange also provides companies with increased visibility and credibility, attracting institutional and individual investors alike. Number 2. Investors. Individuals and institutions who buy and sell stocks on the New York Stock Exchange, either for their own accounts or on behalf of clients. Investors play a crucial role in the price discovery process, as their buying and selling activity helps to determine the market price of a particular stock. Number 3. Brokers. Licensed professionals who facilitate the trading of stocks on behalf of investors. Brokers act as intermediaries between buyers and sellers, ensuring that orders are executed efficiently and at the best possible price. Brokers can be either floor brokers, who physically work on the trading floor of the New York Stock Exchange, or electronic brokers, who submit orders electronically through the exchange's trading system. Number 4. Market makers. Firms that maintain a continuous presence in the market, providing liquidity by buying and selling shares of specific stocks throughout the trading day. Market makers are obligated to maintain an orderly market in the stocks they cover, ensuring that there is always a buyer and a seller for investors who wish to trade. In return for providing liquidity, market makers are afforded certain privileges, such as the ability to trade ahead of customer orders in certain situations. Number 5. Designated market makers, or DMMs. A specialized type of market maker unique to the New York Stock Exchange, DMMs are responsible for maintaining an orderly market in the stocks they are assigned to by the exchange. DMMs facilitate the price discovery process by bringing buyers and sellers together and ensuring that orders are executed efficiently. They also play a crucial role in the opening and closing auctions, which determine the opening and closing prices of stocks. Trading processes. The trading process on the New York Stock Exchange involves a series of steps, from the submission of an order to its eventual execution. Number 1. Order entry. An investor decides to buy or sell a stock and communicates their order to a broker. The order may specify the number of shares to be traded, the desired price, limit order, or it may be a market order, which instructs the broker to execute the trade at the best available price. Number 2. Order routing. The broker routes the order to the New York Stock Exchange, either electronically through the exchange's trading system or by sending a floor broker to execute the order on the trading floor. Number 3. Order matching. The New York Stock Exchange trading system matches the incoming order with an existing order in its order book. If the match is found, the trade is executed automatically. If no match is found, the order may be routed to a DMM or market maker for manual execution. Number 4. Trade execution. The DMM or market maker attempts to find a counterparty for the order, either by fulfilling it from their own inventory of shares or by soliciting other market participants for a matching order. Once a match is found, the trade is executed and the order is considered filled. Number 5. Trade reporting. The details of the executed trade are reported to the Consolidated Tape Association, or the CTA, which disseminates the information to market participants and financial news providers. Number 6. Clearing and settlement. After a trade has been executed, the process of clearing and settlement begins. This involves the transfer of ownership of the shares from the seller to the buyer, as well as the transfer of funds between the respective brokerage accounts. The process is overseen by the Depository Trust and Clearing Corporation, or DTCC, which ensures that all trades are properly cleared and settled. Market structure. The New York Stock Exchange operates under an auction market structure, where buyers and sellers interact with one another to determine the market price of a particular stock. This contrasts with the dealer market structure, where market makers set a bid and ask prices for stocks, and investors trade with the market makers. The auction market structure promotes price discovery and transparency, as orders are displayed in the central order book, and market participants can see the depth of the market for a particular stock. This allows investors to better assess the supply and demand dynamics for a stock and make more informed trading decisions. In conclusion, the New York Stock Exchange plays a vital role in the global financial system, acting as a marketplace for the trading of equities and facilitating the flow of capital between investors and companies. The exchange's auction market structure, combined with its network of market participants, ensures that orders are executed efficiently and at the best possible price, promoting price discovery and market transparency. As a result, the New York Stock Exchange remains an essential hub of economic growth and innovation, supporting the development of new industries and the creation of jobs.